Is your crypto investing strategy more akin to, say, rolling the dice at a casino? Or are you genuinely running it like a calculated business?
Yeah, it's a really critical question, isn't it? Especially remembering that whole YOLO and Dogecoin Wild West phase. We're definitely talking about moving past that now.
Welcome to the deep dive. Today we're plunging into a system designed to shift crypto investing away from hopeful guesswork towards something much more data-driven.
Exactly. And our mission for you is to explore how AI, artificial intelligence, can help pick promising coins, figure out the best trading strategies for them, and then size your positions, all based on some pretty sophisticated risk analysis.
hmm We've got four main steps we're going to unpack. First, how AI can help you choose your coins.
Then second, how to match those coins to the strategies that really suit them.
Third, using AI to actually build a risk-adjusted portfolio.
And finally, the end game. Automation and, crucially, the right mindset for sticking with it.
Okay, so let's start right at the beginning. The big challenge for many people in crypto still is picking coins based on, well, vibes, memes, and maybe a dangerous amount of hope.
Oh, yeah. That leads to that predictable cycle of pain, right?
Yeah.
Chasing hype.
And missing new opportunities because they're always looking into the rearview mirror, at narratives that are already played out.
Right. The real game changer, we think, is using AI that has live internet access. Think about something like Grok, pulling real-time data from X, formerly Twitter. It acts like a global trend spotter.
So using a standard AI without that live feed.
It's like using a history book to predict tomorrow's weather. It's just outdated information for a market that moves this fast.
Okay, so this is where it gets really interesting.
Yeah.
You can prompt the AI, basically frame it as a top-tier crypto analyst. Tell it, focus on market narratives, current trends.
A really effective prompt could be something simple like, considering the latest market narratives and price action, which coins deserve primary focus right now?
And when you did that recently, what kind of analysis did it give back?
It was fascinating, actually. It gave a really balanced snapshot, identified the core foundation, Bitcoin and Ethereum, called them the non-negotiable bedrock, the blue chips, basically. Beat.
Makes sense. The essentials. What else?
Then it highlighted what you might call the challengers, high momentum leaders.
Okay.
Solana and BNB came up strong layer ones, thriving ecosystems.
Okay.
And it even picked out a wild card, a meme-force Dogecoin. But importantly, it added the caution. Treat carefully. High risk, high reward.
So it understands the different risk profiles. What about those really cutting-edge, hot narrative plays?
Exactly. The growth bets. AI tokens were big, Render, TAO, ASI. That intersection of crypto and AI is a powerful story right now.
Definitely.
And DePIN plays. DePIN stands for Decentralized Physical Infrastructure, basically using crypto for real-world stuff like Wi-Fi or data storage. These narratives, these stories, are what capture market attention.
Got it. So that initial AI report gives a solid starting list. But how do we go deeper? How do we know if a narrative is just starting or if it's already peaked?
Well, you can use a follow-up prompt. Ask the AI to quantify the hype. Score the narrative strength, maybe 1 to 10, based on conversation, volume, sentiment, and list the main protagonist coins for each.
Oh, okay. That helps distinguish real momentum from just noise. So, probing question here. What's the core difference this AI approach provides for actually selecting coins?
It spots current market stories, finding which coins truly have momentum right now.
Okay, that leads us nicely into segment 2. This is what I think of as the Moneyball moment for crypto investing.
Yeah, this is where a lot of people trip up.
It really is. Maybe 95% of investors fail here. They find one strategy, maybe buy the dip, and just slap it onto every single coin they hold.
Blindly, yeah.
It's like a baseball manager telling every single player, pitcher included, use this exact same swing. It doesn't work. Different crypto assets have different personalities, different behaviors.
Absolutely. So the fix is to build an arsenal of different proven trading strategies that you can test. For the system we're discussing, 2 have been really key.
Which ones?
First, the Gaussian channel strategy, often used on a daily chart. It's a classic trend-following strategy designed to catch and ride those big, long market moves.
Okay, riding the wave.
Exactly. And second, the Ichimoku cloud strategy, maybe on a 4-hour chart. This one's more about momentum. It helps identify the trend direction, its strength, key support, and resistance levels. Much more granular.
So a trend follower and a momentum spotter. A good pairing.
We've found it's a really solid foundation.
Now, the engine that makes this work, backtesting. We need to talk about that process.
Crucial step.
You basically need a good charting platform. Something like TradingView is perfect, especially its strategy tester. Think of it like a time machine for your investments.
Hmm. That's a good way to put it.
Seriously, it lets you simulate how a strategy would have performed on a coin over, say, the last 5 or 7 years. It condenses potentially a decade of trading experience into, like, 30 seconds.
It's pretty powerful stuff.
So the process looks like this. You set up your lab, load those AI-picked coins into a watch list on TradingView. Apply one of your strategy scripts like Goshen or Ichimoku to the chart. Then you run the time machine, configure the backtest settings, hit go. It simulates every single trade based on the strategy rules over all that historical data.
Then the important part, capture the results.
Right. You grab the key performance data from the report and put it into a simple spreadsheet. We call it a dossier. You log the metrics for each coin combined with that specific strategy.
And then you just repeat systematically for every coin on your list with every strategy in your arsenal. And backtesting, just to be clear, simply means simulating a strategy on past data.
Okay, so your spreadsheet starts filling up with numbers. What do they actually mean? What should people focus on?
Good question. You'll see net profit, or ROI percent. That's the bottom line, obviously. But honestly, it can be misleading on its own because you need to look at max drawdown percent. This one's maybe the most important for risk management. It tells you the single biggest loss streak your capital experienced, peak to trough. A 60% drawdown. That means at some point, your portfolio could have been cut in half.
Oof. Okay, yeah, that's the scary one. Understanding that helps manage the emotional side, I imagine.
Totally. It prepares you. Then there's the Sharpe ratio. This is the real Moneyball stat. It measures your profit relative to the risk you took to get it.
So higher Sharpe is better.
Generally, yes. A high Sharpe ratio suggests smoother, more consistent returns without those terrifying drops. Often much better than just chasing the absolute highest profit number.
Interesting.
And lastly, win rate percent. How often your trades were profitable. It feels good, it's an ego stat, but beware.
Right.
You could have a high win rate with lots of tiny wins, but if your few losses are huge, you're still losing overall. Max drawdown, remember, is that largest peak-to-trough decline.
So probing question from you this time. What's the biggest mistake people make by ignoring max drawdown?
They risk emotional panic during inevitable deep market corrections. Selling low, basically. Mid-roll sponsor read.
Okay, so you've done the hard work. You've got your coin list, you've back-tested strategies, you've meticulously gathered all that performance data into your dossier. What now?
Well, this is where many people, even if they get this far, make a common mistake. They just allocate equal amounts of capital to each coin strategy pair that looks decent.
Right, just divide the money evenly. That feels like amateur hour, doesn't it?
It kind of is. A professional approach focuses on building a portfolio based on risk-adjusted returns, not just raw profit potential.
And this is where AI comes back in, but maybe a different type.
Exactly. For this task, analyzing the backtest data and deciding on allocations a powerful reasoning model like ChatGPT-4 or specifically the newer O model seems ideal. It's really good at sifting through data, understanding nuance, and making allocation decisions.
So how do you prompt it? What do you tell the AI to do with all this spreadsheet data?
You need to be quite precise. You tell it something like, okay, I'm going to upload several files containing trading strategy backtest results. Please extract all the data from each file and hold it in your memory. You might have to upload in batches, maybe 10 files at a time because of limits.
Okay, practical tip there. And once all the data is uploaded?
Then you give it the core task, something like review all the data thoroughly. For a target investment of, say, $1,000, recommend the optimal strategies and capital allocations. Prioritize the Sortino ratio. Give slightly more value to strategies with a higher number of trades, as that indicates more statistical significance. But above all, focus on reducing overall portfolio risk while still capturing upside.
Okay, you mentioned the Sortino ratio there. What is that, quickie?
It's similar to the Sharpe ratio, measuring risk-adjusted return, but it only penalizes downside volatility. The bad kind of volatility. It doesn't punish you for upside swings.
Got it. So focusing on downside protection, what did the AI recommend when you ran this recently with a $1,000 example?
It was really instructive. The AI built a portfolio that was a masterclass in balancing risk and reward. The top allocations, the core holdings, went to Solana using the Goshen strategy that got 28%, and Bitcoin, also with Goshen, got 21%.
Light of.
They consistently showed that great balance, strong profits, but with moderate manageable risk, according to the backtests. Beat.
Okay, so about half the portfolio in those core pairs. What else?
It identified a low-risk powerhouse, a coin called HYPE, using the Ichimoku strategy, that got 18%. It had solid returns, but crucially, A really low max drawdown in the tests, only 9%. Very stable.
Wow, 9% drawdown is impressive.
Yeah. And Ethereum with Ichimoku got 16%. That one showed a staggering 5,700% profit over 7.5 years in its backtest. A real consistent performer.
Okay, but not the biggest allocation despite the huge profit.
Exactly, because the drawdown was higher, around 43% risk management. And finally, the lottery tickets, the meme coins like Ogiwugo, they got a small combined slice, maybe 17% total for a few of them.
Why include them at all if they're so volatile?
To manage that high volatility while still giving you some exposure to their, potential explosive upside. Small bets on big possibilities.
So the AI isn't just a calculator, it's acting like a strategic portfolio manager, making these nuanced risk decisions in real time. That's the game changer.
It really is.
Whoa. Imagine scaling this level of risk-reward calculation across thousands of assets. The AI truly becomes a quant analyst at your fingertips. 2-sec silence. So this isn't random allocation, it's rooted in the math.
Absolutely. The AI's main goal wasn't just picking the pairs with the highest profit numbers. It was finding that sweet spot, that optimal balance between risk and reward.
Like with Ethereum plus Ichimoku, massive 5,700% profit potential, but that 43% drawdown meant it was a star player, yes, but too risky for the largest chunk of capital.
Precisely. And then it saw HYPE plus Ichimoku, lower overall profit maybe, but that incredibly low 9% drawdown made it a reliable defensive player. Strong returns without the heart palpitations, that's why it got a significant slice. Its risk-adjusted return, its Sharpe ratio, was excellent.
And the meme coins. Tiny allocation because the risk is huge, but you still want a little exposure just in case one takes off.
You got it. That's the secret sauce. Risk-adjusted position sizing. Position sizing just means deciding how much money to put into each specific trade or strategy.
The AI uses Sharpe, max drawdown, consistency, maybe even current market vibes to decide. High drawdown potential equals smaller position size. Moderate returns, but low drawdown. Bigger position, meme coin, tiny position for that upside potential.
And importantly, this isn't just theory. We've seen these strategies deliver in the real world. That HYPE strategy, for instance, was up 136% recently based on these signals.
Okay, so clarifying question. This AI doesn't just pick good coins or good strategies. It specifically decides how much capital to allocate to each specific pair.
Yes, precisely. Based on each coin strategy pair's unique risk-adjusted performance profile.
All right, you've done all the brain work. The AI analyzed the market, the data's crunched, the back testing's done. You have this mathematically sound, risk-adjusted portfolio plan. Now, the final hurdle, maybe the hardest one.
Taking yourself out of the equation, your own emotions.
Yeah, automate everything. Because your emotions, fear, greed, FOMO, panic, they are absolutely your worst enemy when it comes to executing a trading plan.
Couldn't agree more. Fear screams sell right at the bottom. Greed whispers go all in on something already up 1,000%. FOMO, fear of missing out, makes you chase pumps way too late. Panic makes you snatch tiny profits or cut winners too soon.
It's like the daily market noise is the siren song from mythology, right?
Yeah.
Luring your ship onto the rocks of bad decisions.
Great analogy. And automation is how you strap yourself to the mast. You use trading automation platforms, something like Cigna, maybe that connect to your exchange account like Binance or Coinbase.
And they just execute the plan.
They execute the AI-generated plan, 2-4 to 7. With cold, calculating, emotionless precision. It takes your itchy trigger finger completely out of the loop.
Okay, that makes sense. And this leads to what you call the zen of systematic trading. It's a mindset shift, isn't it?
Absolutely crucial. You have to understand this is not day trading. You're not trying to scalp tiny profits minute by minute.
Right.
This is systematic trend following. That means a strategy designed to identify and follow major market trends over weeks, maybe even months.
Think like a farmer, not a hunter. Is that the idea?
Exactly. A hunter chases every little movement, gets exhausted, maybe gets small rewards. A farmer plants seeds based on a plan, waters them, trusts the process, and waits patiently for a big harvest.
That requires discipline, though. Trusting the math, ignoring the daily news cycle, resisting that urge to constantly check your portfolio balance.
It is tough.
I have to admit, I still wrestle with that farmer mindset myself sometimes. The urge to just quickly check the portfolio. It's a real battle, even when you know you shouldn't.
It takes practice. It really does. Trusting the system.
So once someone masters this two-strategy approach, maybe Goshen and Ichimoku, what's the next level?
You can build a multi-strategy portfolio. Instead of just 2 strategies, you might test 3, 4, 5 different types of strategies on each coin.
Like,
Well, you'd keep momentum strategies for trending markets. Add mean reversion strategies, those trade when prices get stretched too far from their average, expecting them to snap back.
Okay.
Maybe add breakout strategies, they trade when price decisively breaks through a key level. And you could even incorporate DCA dollar cost averaging for steady, long-term accumulation.
so diversifying not just by coin, but by strategy type. That makes sense for handling different market conditions, choppy, trending, exploding.
Precisely. It makes the whole system more robust.
Just a quick technical reminder for anyone trying this. Those AI models often have file upload limits.
Right.
So if you're analyzing, say, 50 coin strategy pairs, you'll likely need to upload the data spreadsheets in batches. And always include a line in your prompt asking the AI to confirm it's got all the data and is holding it in memory before it does the final portfolio allocation.
Good point. Don't want it working with incomplete info. Okay, final probing question for you. What's the single most important habit for success in this entire system?
Trusting the math and letting the automated system do its job. Resisting the urge to meddle.
Couldn't have said it better.
So the big picture here. The crypto market is maturing. That Wild West phase of pure gambling, it feels like it's fading.
Yeah, success now is leaning much more towards systematic, data-backed plans. Less guessing, more calculating.
And the really exciting part is that AI makes this sophisticated, almost professional-grade approach accessible to basically anyone. You don't need that PhD in quant finance or a team on Wall Street anymore.
The tools are becoming democratized. The choice really is yours now. Are you going to keep gambling based on gut feelings and emotion? Or are you going to start calculating using math, data, and automation?
We'd encourage you, the listener, to think about how this kind of AI-driven, systematic approach could apply elsewhere in your life too, beyond just crypto. Where else could better data lead to better decisions?
And maybe a final thought to leave you with. If AI can help us build a portfolio designed to navigate something as volatile as crypto markets, what other complex decisions, big or small, in your own life might benefit from a calmer, more data-driven approach? Something to mull over.
We hope this deep dive gave you some valuable insights. Join us next time. I'll use your own music.